Today, I'm going to provide a brief breakdown and analysis of the CFPB's proposed mortgage relief for small and rural financial institutions. I'm Jeff Anderson, an attorney at the Dickinson law firm. I'm a member of the firm's bank practice group and the head of the firm's regulatory compliance subgroup. The reason I want to provide a webinar on this proposed rule is I thought it'd be helpful to put out just a quick breakdown so that you don't have to read through the entire 100-page proposed rule. As a background, the rules we're talking today are focused around the small creditor and rural and underserved exemptions from the 2014 mortgage rules. So I don't want to spend too much time on the 2014 rules. I have other webinars out there in detail on each of the rules, on the escrow rule, on ability to repay, qualified mortgage, that you're welcome to just shoot me a message. My contact information is at the beginning, and I'd be glad to provide those webinars out to you if you need more background information on the rules as they currently stand. So starting to go through the 7 major changes that are proposed in the CFPB's January 29th proposal. The first is a broadening of the definition of small creditor. So your current definition of small creditor involves 2 prongs. 1, you have assets of less than $2 billion. 2, you originate 500 or fewer covered transactions in the previous year. And covered transactions being closed-end first lien consumer mortgages. If you meet those 2 prongs, you can qualify as a small creditor, and subject to the requirements in the reg, you can make small creditor qualified mortgage loans. A lot of financial institutions have commented on that standard both before the rulemaking and before the final rules and subsequent to that, and commented that that was too narrow, that it doesn't encompass enough of the creditors that really should be considered small creditors. The CFPB, to their credit, has taken a look at this, and now in this proposal, they're proposing a very significant expansion of that definition. So a few ways they're expanding it. The major way is they're proposing to expand the originated loans threshold from 500 to 2,000. That's a quadrupling of it and could really fold in a lot more financial institutions under the small creditor exemption. On the asset side, they're proposing to keep it at $2 billion, but they're expanding the definition a little bit to possibly include some more assets into that $2 billion because they're proposing to include the assets of any affiliates of the institution that also originate mortgages. So if you have affiliates that do things completely outside of originating mortgages, that wouldn't count towards the $2 billion threshold. But if you have an affiliate that's involved in loan origination and consumer mortgage origination, that's going to count towards the $2 billion threshold. One other big addition to this exemption, in addition to broadening it from 500 to 2,000, they're also proposing excluding loans held in portfolio from counting towards the 2,000. So the current rule as it stands, it's 500 or fewer closed-end first lien mortgages in the preceding year. Every loan that's originated counts towards that 500. The proposal expands it to 2,000 and only counts loans that aren't held in portfolio. So any mortgage, closed-end first lien mortgages that your institution would be retaining in portfolio would not count towards that 2,000. One caveat that's buried in the 100 pages there a little bit is that exclusion of portfolio loans is not going to include transfers to an affiliate. So again, if you're an institution that has an affiliate that also originates mortgages, their assets are going to count towards the $2 billion, but also if you originate the loan at the institution level and then transfer it to the affiliate, it's going to count towards the 2,000. So just because it's kept in-house under the holding company level doesn't make it a portfolio loan. It has to stay at the entity that originated the loan. So that's a very significant broadening. I mean, the asset definition is actually a bit narrower because now they're bringing in potential assets from affiliates. But I think that's more than outweighed by the expansion of the origination threshold from 500 to 2,000. The second of the 7 major changes is a broadening of the definition of rural. So the current rule, if you originate 50% or more closed-end first lien transactions in a rural or underserved area, you can be exempt from the HPML escrow and second appraisal rules and the prohibition on QM and high-cost balloon loans. That current definition of rural is tied to the metropolitan statistical area or a micropolitan area adjacent to an MSA. So that, again, a lot of comments have been received on that by the CFPB, stating that that's much too narrow of a definition of rural. A lot of communities, a lot of community banks and other financial institutions fall outside of this definition of rural, even though they really are operating in a small rural community. What they've proposed is to broaden that definition. So they're keeping the current definition. So you'll still qualify as rural under the proposal if you qualify as rural under the current rule. They keep that. They're proposing to add a new prong, where if you're not under the first prong, being not in an MSA or a micropolitan area adjacent to an MSA, you can still be rural if you're in a census block that's not defined as urban by the U.S. Census Bureau. Now, urban, I won't get into great details of how it's defined, but if you have a population of 50,000 or more in the census block area, you're clearly urban. And in some instances, if you're between 2,500 to 50,000, you may be defined as an urban cluster, depending on other factors. But the real takeaway is the old rule with the metropolitan statistical area, they were tying it really to counties. And counties can have urban areas mixed with rural areas. It's very difficult to just label a county urban or rural. I mean, here in Iowa, where I'm from, probably 95% of the land mass here should be defined as rural, but it's not under the current rule, just because of that being adjacent to a metropolitan area eliminates so many financial institutions from falling under this. So we're going with this broadening from 3,000 counties to 11 million census blocks that are in the United States. That's breaking things down at a much more granular level that hopefully will be able to better identify the communities that really are rural and allow the institutions in those communities to make more loans under these exemptions. Third change is a change in the time period for determining if you're making loans predominantly in a rural and underserved area. Right now, the current rule is you make 50% or more covered transactions, and the look back is 3 years. So if you did that in any of the preceding 3 years, under the current rule, you are going to qualify as rural or underserved. It's a rolling 3-year look back period. Under the proposed rule, they're proposing to cut that back to 1 year. So it's the same 50% plus covered transactions, but it's just looking back in the preceding year, much like the small creditor exemption only looks back to the preceding year. Now, the rationale in doing that, making it more restrictive, is that they initially passed that 3-year look back because a change to the definition of rural under, as it was used in the current rule, was imminent. And it would have resulted in some financial institutions adjusting to being, okay, we're under the exemption, and then a year later not being under it, or not qualifying for the exemption when the rule came out, but then when the definition changed, qualifying for it. And they wanted to give some ability for financial institutions to plan accordingly looking forward. given that imminent change. Now the CFPB reasons that the 3-year look-back period isn't necessary because with the expansion of the definition and including any non-urban areas as defined by the Census Bureau, they're only really going to be changing the definition approximately once every decade, and that financial institutions should be able to keep up with that. The fourth change is to the eligibility for the escrow exemption. This one's not really a change to the current rule. It's more of an addition that goes along with the other changes we've discussed. So under the current escrow rule, in addition to requiring you to be a small creditor predominantly making loans in rural or underserved areas, you're not eligible from the exemption from escrowing for loans if you're currently escrowing. So even if you are a small creditor, even if you do predominantly make loans in rural and underserved areas, if you've been escrowing in the past, you're not going to fall under the exemption. The rationale for the current rule being that way is, well, if you're currently escrowing already, it can't be that burdensome for you, so we're not going to provide you with an exemption. That can create a potential conflict, as you can imagine, with the proposed rule, and so what they're proposing is you're not going to lose your eligibility under this proposed rule if you're only escrowing because of complying with the January 2014 rule. The fifth change is a safe harbor for a definition of rural or underserved. So the CFPB said if we or the Census Bureau put out any automated tools that allow you to make a determination of where your loans are made and whether it's in a rural or underserved area, you can rely on that. It's a safe harbor. They haven't set a timeline for when they're going to come out with these automated tools or if they will, but if they do, then you'll be able to rely on those as a safe harbor. And that's in addition. So in the gap between when those tools are out, they'll have those published lists like they do right now of what areas are exempt, and you can rely on those. Sixth of the 7 proposed changes is an extension of the 2-year balloon transition. So you'll recall that with the initial rules, they first came out with them and said you can only make balloon loans and have them be a qualified mortgage or have it be a high-cost mortgage. You're a small creditor and you predominantly make loans in a rural or underserved area. A lot of comments were received that said, oh wait, we don't meet your restrictive definition of rural, but our community really needs these balloon loan products. We need to make these. And so the CFPB heard that, and back in 2014 they said, okay, well, we'll give you a 2-year cushion where it doesn't matter whether you're in a rural or underserved area. If you're a small creditor, for 2 years until January 1st, 2016, you can make balloon loans and have it be a QM and a high-cost loan. This change is simply they're extending that from January 1st, 2016, 3 months later to April 1st, 2016. The 7th is grace period. This dovetails with that change to April 1st. So you can imagine if you're a creditor that is towing the line of the threshold. So let's say you're, at, under the current rule, 480 originated mortgages and it's getting close to the end of the year. If you have a very intrepid loan originator who closes 21 loans on December 31st, originates that many loans that day, you're going to go over the threshold and you've got to start complying with it the next day. And it might be very hard to plan, very hard to adjust in those instances. Same thing with the rural or underserved, where if that changes at any given time, and the way the rule currently stands, you could have to turn around and comply very quickly. So what they're proposing is inserting some grace periods into the rule. So if you exceed any of the thresholds, be it the $2 billion asset threshold, the proposed 2,000 origination threshold, you'd be able to continue on as a small creditor until April 1st of the following year. It gives you that 4 months to transition over. Same on the rural side. If you were operating as a rural underserved lender, and then in a given year you fall below the 50, now you're at 49%, you're not going to be able to do that anymore. You're going to have to start escrowing. Now you have until April 1st to do that. A little bit of a transition period anyway. So that's the 7 changes, mostly positive changes. I mean, there are a few places like adding in affiliate assets and trimming down the time period of the look-back period for the definition of rural that tighten things up a little bit. But overall, this is a very positive proposal for financial institutions. A lot more financial institutions are potentially going to qualify as small creditors. A lot more financial institutions are going to potentially qualify as predominantly lending in rural or underserved areas and be able to hopefully make more loans in their community because of these rules. Now, studies have started coming out in recent weeks where community banks and other lenders are saying that these rules came out and now we're seeing more restrictive lending terms and less lending in communities, and it's because of these rules. The hope, I think, from the CFPB is that by allowing more entities to get under these small creditor and rural exemptions, it will loosen that up a bit. So some key takeaways. One is that the CFPB listens to comments and is willing to revisit the rules. So they listen to the comments and finalizing the rules, but that doesn't mean that you need to stop commenting to them when something doesn't work or doesn't make sense or isn't really protecting consumers or your community. Comment to them because they really do listen to them. I mean, they listen to the consumer group comments as well, of course, but I think this proposal really shows that they're not just paying lip service to the commenting process, particularly from the industry, from trade associations and financial institutions, that they really are willing to listen. So I'd encourage you to comment not just on this proposal, but on other CFPB proposals as well, that it really does make an impact. Now, other takeaways and action items, this is just a proposal still. So there's nothing to implement yet. There's no effective date. In theory, it could be completely scrapped and it goes away. But I really don't think that's going to happen. It's not been the CFPB's practice to do that. They really only propose a rule if they intend to go forward with it. So I don't think, even though it is just a proposal, and I don't think it's too early to start initial planning. I'm not saying start implementing it or start drafting policies and procedures, but start thinking about strategically, if this proposal were to be finalized in some form similar to this, expanding those definitions of small creditor and rural, how would that impact your institution? How could you benefit from it? Are there certain things you can do now or can plan to do that would allow you to take full advantage of it? So start thinking about some of those. If you want the slides from this presentation, or if you want any of the other webinars that I've done on the 2014 mortgage rules, just reach out to me and let me know, and I would be more than happy to provide them to you.